Good afternoon to everyone present here today. It is our pleasure to welcome you to our webinar, Finance First Small Business Funding in the Gulf Region. This is the second in our series of strategic webinars we are holding with young Arab leaders who have been our strategic collaborators since 2018, for which we are extremely grateful. For those of you that aren't familiar with the PEARL Initiative, PEARL Initiative is the leading and only independent non-profit organisation founded to promote the business case for the implementation of the highest standards in corporate governance, accountability and transparency across the Gulf region's private sector. Launched in 2010 in cooperation with the United Nations Office for Partnerships, the PEARL Initiative aims to convene businesses, decision makers and future young leaders to take the lead in promoting and adopting greater governance standards. The PEARL Initiative also engages with the wider business ecosystem in the Gulf region, collaborating with over 30 regional universities and partnering with over 40 companies to collectively drive our mission forward. We work as a think tank and build data by publishing cutting-edge research reports and case studies to inspire business change. To give you a brief introduction into the programs, the way we deliver our work is programmatic in the organisation, and we structure our programs in accordance with different themes and addressing different sectors. So today's series is obviously being held as part of our Governance and SMEs program, and it was born out of the fact that MSMEs are considered to be the backbone of the regional economy. They do account for between 80% and 90% of registered companies across the region, while their contribution to regional GDP does remain quite low. As SMEs do compete with each other in a saturated marketplace and strive to be both innovative and fiscally sustainable, they must understand the fact that implementing corporate governance is the key to facilitating their growth and success. The PEARL Initiative understands the necessity of good governance for small business success, and in 2017 we launched the Governance and SMEs program to engage small businesses on the importance of corporate governance with positive economic outcomes. Good governance is flexible and can be modified to fit a business need. It isn't solely meant for the realm of multinationals or large corporations, as is often thought or considered. SMEs will find that applying governance policies and practices will help them build a stronger, more resilient and more profitable business than before. About the webinar, we are pleased to have this webinar on Finance for SMEs. A common lament in small business circles is that funding sources are too few and far in between. With economic conditions playing as harrowing a role as lack of funding in SME management, it is important to understand how small businesses should approach funding and how they can get access to financing strategically. As I mentioned, we are holding this webinar series in collaboration with young Arab leaders. I'll quickly give you a quick introduction to young Arab leaders. They are also a not-for-profit organisation founded during the World Economic Forum in 2004, under the patronage of His Highness Sheikh Mohammed bin Rashid Al Maktoum, Vice President and Prime Minister of the UAE and ruler of Dubai. YAL seeks to leverage the capabilities and expertise of its strong regional network of members in order to catalyse the entrepreneurial and professional development of the next generation of leaders. Its mission and vision is to empower the next generation of leaders in the Arab world by developing a strong network of industry and business leaders to serve as mentors and role models to the youth and entrepreneurs across the region. It does so by fostering entrepreneurship and innovation and creating a hub for new business and investment opportunities. YAL has a mentors and advisors network, is engaged in community initiatives such as entrepreneurship workshop series, a mentorship program and weekend competitions, and has a vast support network. Once again, I would like to extend our thanks to YAL and their support and commitment to the mission of promoting corporate governance and transparency across the Gulf region, private sector. To quickly introduce you to our speaker today, who's very kindly given up her time. Thank you, Huda. Ms. Huda Al Lawati is a YAL board member and partner at Gateway Partners and will be our expert facilitator today. Huda has a career that spans 18 years in private equity and investments across emerging markets. As partner at Gateway Partners Group, she is a member of the investment committee and leads deal origination, execution and portfolio management in the Middle East and Africa regions. Prior to Gateway, Ms. Al Lawati was Chief Investment Officer for Savola Group, one of the largest publicly listed strategic investment holder groups for food and retail business in the Middle East and North Africa region. Huda is currently a board member at Tim Hortons Middle East and Gateway Delta Development Holdings Africa, and holds a Bachelor of Science degree in Neuroscience and a Bachelor of Arts degree in Business Economics from Brown University. Huda, welcome, and we look forward to hearing your strategic insights. Before I hand over, I'd just like to urge you that these sessions are interactive. They're intended to be two-way conversations. I know it's not as practical as real-life events, but the system does enable questions. So as you've all registered, you can file your questions through to Huda, and Huda will endeavour to respond to those throughout the webinar. She may not respond immediately, but may address them at the end of the session. So do file those through. And take advantage when you've got such an expert at your disposal to glean her insights. So thank you, Huda. I'll hand over to you right now.
Thank you very much, Yasmin. Good afternoon, everybody. I hope everyone is keeping safe and healthy. Thank you for joining today, and thank you to Pearl Initiative and Young Arab Leaders for hosting this. I know it's a difficult time. We're all, or most of us are at home. It's good to exchange perspectives, hear what other people are thinking. I know I've been joining a lot of webinars myself, and hopefully this would be of some use to some people. With that, I'll just get into it. Today, the topic that we're scheduled to discuss is small business funding in the Gulf region, which is no small feat, especially if you're outside the tech world. But given the environment that we're in, as you can see in this next slide, I've sort of amended that to say business funding in the Gulf region during a crisis. We are all witnessing a global pandemic, and it's a unique situation, not just in our lives, but in world history, and I think we will see things change for a long time. It would be remiss to have a discussion on funding without doing it from the perspective of this situation that we find ourselves in. Today, it's not just SMEs and new business startups that are struggling for funding. The world over, large corporations, businesses across all sectors are feeling pressure. So to start with, I'd just like to sort of recap what happened. Well, there was a virus outbreak, and there was a very strong global reaction to that outbreak, given the mortality rate and the sort of strain it puts on the limited healthcare systems that we have. There were border closures, hospitality closures, retail closures, schools were closed, movements were restricted, curfews, lockdowns, working from home mandatory in many cases, optional in some, but ultimately largely the world seems to be coming to a halt almost. That in turn has led to both a supply shock, because with all that closure and limited movement, there will be issues in getting things around. There's going to be issues in supply. We know that it started in China, which obviously supplies a lot of what the world consumes and uses. So that was felt. That was coupled with a demand shock. No travel, no movements, so airlines, hotels, transport businesses, ride sharing, leisure businesses, shopping, nobody's buying or renting property, schools are closed. Of course, with such a big demand and supply shock, there's a huge impact on business. Businesses, when impacted, often do and have done layoffs. Layoffs in turn cause further consumption loss, which causes further demand destruction, more impact on businesses, further layoffs, and it turns into a vicious cycle, which is effectively the recessionary environment that we are witnessing today. And of course, we are in the GCC, so we cannot forget about oil. It has seen a monumental drop. The recent deal in the last 2 days, which cut about approximately 10 million barrels per day of production, does not compensate for the demand loss, which is now estimated at somewhere between 18, 19 million barrels per day. Importantly, the budgets of our governments in the GCC balance at much higher oil prices than the current price of 33 of Brent, or the lows that we've seen, and they balance at 3-4 times that amount. Added to that, they are having to fund the current emergency as well. This year, actually, for this region was supposed to be a year of recovery. Saudi settling in after the reforms that started in 2016, mega projects expected to start yielding results, UAE Expo 2020, other initiatives like Abu Dhabi, all of that was supposed to make 2020 a recovery year for us, because we have had a slower growth curve recently than we've had in the past. Of course, all that is shattered, as shown in these Pitch Solutions charts, by the COVID outbreak and oil price collapse. Now, this chart stops at 2020. The question is, how does recovery look like from here? I'm sure you guys have heard about V-shaped recovery, U-shaped recovery, even W-shaped recovery in terms of, recovery, resurgence of virus, and then a drop again. Alphabet aside, I think the reality is that this is leading to a lot of job loss already, and a lot of capital being spent. So it's going to be a protracted downturn with a very difficult recovery across the board. So what does that really mean in the context of the subject that we're trying to tackle? Let's look at how it changed things, firstly, for financiers. Now, in a reaction to this situation that we find ourselves in, we're having to do closures to, prevent a worse health issue. But the economic fallout from that is immense. And so governments are trying to do whatever they can do to soften the blow. Central banks everywhere are printing money, injecting fiscal stimulus. And the impact of that basically is that money becomes cheap. UAE Central Bank has announced 100 billion dirhams of a stimulus package. Saudi Monetary Authority has announced 50 billion riyals. That's in addition to 70 billion riyals of government fees and exemptions that they've announced. Governments across are saying you can delay mortgage and loan payments. Some governments are supporting salaries, at least for locals. Obviously, these are big numbers in local context, but they are not going to be enough at the rate they're at today. U.S. is looking at some 4 trillion of stimulus and rescue packages in this context. For money pockets, their life has changed considerably. Now, on the left side here, it's showing you the situation where money pockets, whether those are high net worth individuals, funds, banks, governments, whoever it is, they were receiving money from their businesses or their operations. They were receiving money from their investments, they were receiving interest income, and they were allocating to new investments. The reality is that SMEs already received a small, and in the case of banks, probably in the GCC, negligent share of that. And the tech startups had recently seen a surge in VC funding in recent years. But with COVID, life has changed a lot. You're having to put money back into businesses or portfolios to rescue them. If you have borrowed for investments, you're having to pay margin calls because the value of assets has come down. Interest income, obviously, with the rates being where they are, is a lot less. So a new activity is all but stopped to a large extent. Now, this guy shown here is not representing a lack of money. We've talked about money being cheap, and we've all heard about the trillions that are out there. This is more, I would say, representative of how people are feeling about the situation, because they are worried about capital loss. They're worried about future income. And depending on where you are in the world and which asset class you sit in, that trillions or wall of money that people talk about is not always there. A lot of it is specific to U.S. or developed market institutions. What does that where does that put the investor? It means that for the governments, they are instituting spending cuts and reallocating to emergency resources. They're also tapping debt markets. Abu Dhabi issued a $7 billion bond. It was oversubscribed 4 times at almost 3.2% yield. Dubai is in a more modest-sized bond as well, because they're going to have to, they know because of the oil price and what they have to spend out, that they're going to have to support the economy. And cost of capital is low, but all these investors, as you said, are seeing income contraction. They're seeing defaults. They're having to rescue businesses. The resulting situation is that it has become a buyer's market. They will pick and choose when they allocate what they allocate to, and they will be demanding their terms. There's a flight to quality, and there's a flight to relationships. Now let's move on to the business side. How are things changing with businesses? This is a chart showing the changes in consumer habits. Now this demonstrates changes in US. It's the source of New York Times, and it's based on credit card data. But based on what we've read about China and what I'm seeing here in businesses, is pretty accurate representation of what the lockdown and COVID-19 are doing to consumer habits. Things that are consumed online, at home, are essential, are growing. Video streaming, gaming to keep people entertained, food delivery, online grocers. Home improvement is an interesting one. DIY is growing at 8 or 10 folds in the US, depending on who you ask. People are sitting at home, spending time doing a lot of DIY sort of stuff, which is also cheaper. Just about everything else is losing steam. Even healthcare, people tend to think that this is health sector will be growing. It's not true, because a lot of the private healthcare, hospitals, clinics earn a lot of income on elective procedures, on not necessarily critical care, and all that's part of it. So that's seeing a hit as well. Fast food, similarly, yes, delivery fast food is a sector which gets tapped into, but all in all, taking the closures of the retail outlets, it is seeing an overall drop as well. There is nuance to what we're talking about here in terms of consumer habits. Certain consumer habits that are changing are temporary changes, or changes that result in growth for certain sectors during the lockdown or during the crisis. Others are sort of cause lasting changes, or has the potential of causing lasting changes, such as habits of working from home or ordering grocery online. It may not be quite as high as it is today, but certainly there will be some conversion that is lasting. And finally, for the sectors that are seeing the shrinkage, some are more lasting or will take longer to recover than others. Luxury goods, for example, China has shown has been a temporary downturn, and it's bounced back pretty quickly. Other places where there's sort of communal activity, theaters, restaurants, recovery may be slower. Some might recover, others might not, and so on and so forth. Moving on to liquidity. Liquidity is more important than ever to any business. Even if you are a beneficiary of COVID and you are growing, you will, the chart is not showing up on the slide, I'm not sure why. In any case, basically, whether you want to fund the growth, your growth, or you want to survive the crisis, you will need liquidity. I have recently received decks for companies that are growing at 5-6 times compared to last year, but they very much are able to grow to death, unfortunately, because that growth entails getting more people on board, entails spending more on getting goods out. It's an e-commerce type of business, and without funding, that business will not be able to sustain itself. and there are many more out there of similar nature. Moving on to networks. Who you know will matter very much. This is the time when your networking should be paying off. People are not looking to develop or focus on new relations. They're really focusing on their existing relationships and existing networks, and so those are the people that will be available for you to tap into. Finally, the crisis for businesses is going to surface weak or disruptible business models, and it brings a lot of things into question. Basic business model questions are tested. For example, subscription or prepayment-led businesses initially at the start of the crisis will fare better because they would have had the liquidity. I don't just mean online subscription businesses. Schools are a good example of this because people typically pay fees in advance. For online businesses, unit economics surface very quickly because a lot of businesses will come with the ones who are doing well with the higher growth than they had anticipated, and if they've hit their 3-4 year projections with that growth, which was supposed to result in profitability from scale, and that's not happening, they still can't quell the cash burn, then that brings their business model and unit economics into question. Because of the uniqueness of this crisis, long-term industry outlooks come into question as well. For example, the sharing model, because of hygiene concerns, there's been a lot of talk about Airbnb and how comfortable people would be with that, or rather how long it will take people to get back to being comfortable with those kind of models. This may have accelerated the work from home trend, which people have been talking about happening more and more into the future anyway. That calls into question commercial real estate, shared office space business models. Business travel needs are also being reassessed. I think a lot of us are discovering that we can get a lot done sitting at home, remotely, virtually. It's effective, it's efficient. This is important because business travelers account for 12% of airline passengers, but twice as profitable as the other travelers. On some flights, business passengers can represent 3/4 of an airline's profit. So that would be a big challenge for the airline industry. Brands will gain relevance. When you're buying a sanitizer, you are more careful than ever about Dettol. There's been a lot of commoditization, less in our region, more globally in developed markets, but this private label and lack of brand trend may see a little bit of reversal because trust really matters to consumers. Finally, some environmental-driven boycotts of strong detergents, single-use plastics, disposables could lose steam. Companies like Tim Hortons and Starbucks have temporarily paused reusable containers already. So what does that mean? That means that the value of essentials is reestablished. Digitization becomes a must-have, and liquidity is key for either growth or survival. Discretionary categories that are just seeing a temporary drop can recover, but the accelerated digitization may lead to lasting changes. Relationships will matter, business models will be tested, and brands will regain value. So in this environment, what should you be doing? The first thing that you need to do is that you need to understand where you fit. Are you a business that is growing during the crisis and you need capital growth? Are you a business that is robust and has long-term demand but is challenged temporarily? Or is your business model or the industry you operate in altogether coming into question today? Let's look at some examples in each of these areas. And in each area, there's also some nuances. So if you're growing during the crisis, first of all, I think one thing that people miss a lot when they talk today is let's say the corona-driven sectors. Today we're seeing growth in businesses like supermarkets, e-grocery, online entertainment, food delivery, hygiene, households, telemedicine. If you're in these sectors, it's a good place to be in. We'll come to what you need to do. But one thing to keep in mind here is that you also have to assess whether you are in a business that is growing during the crisis and will slow down thereafter or end up in oversupply. Are you in a business where, for example, e-grocery, you're growing and this crisis has taken your growth path or accelerated the industry growth in a way that, you were expecting that will happen in 3-4 years. I suspect things like, manufacturing of masks and production facilities producing sanitizers will be things that may end up at the end of this situation in overcapacity even. So it's very important to know if you're growing during the crisis, where you sit. If you are a robust business model, but you're challenged temporarily, you could be a luxury goods seller. You could be in a hospitality or leisure business, sporting business. You could be in beauty services, clinics, even restaurants, ride sharing. Here, the nuance is more about timing. These businesses, these businesses will have demand in the long run. They will recover. But given the health scare that we've gone through and the crowd scare that we've all witnessed, some of these businesses will rebound faster than others. And you have to be very, very careful on what kind of timeline of recovery you sort of plan to, because that will have a bearing on your need for capital and your the measures and the severity of the measures you have to take to manage that. And if you go to the let's say broken business model or challenged industries, what am I talking about? I'm talking about the kind of businesses that have a broken model. They're growing, but at an expanding loss. We discussed that in a few slides ago. Shared living potentially can be a challenged industry, commercial property likewise. In the GCC specifically, there are businesses whose models are very dependent on the expansionary government budgets of 2020, 2021, whether that's the mega project of Saudi or Expo 2020. Those businesses will find it difficult to find, not just during the crisis, but post-crisis as well. So once you've understood that, where you stand, you then have to consider your funding options. Funding options are basically, I've put 6 here. The first one, which is available to everybody, is cost cutting. Everybody should be doing cost cutting. People should be looking at their fixed costs, looking at their efficiencies, and trying to do whatever they can to preserve capital through improving that. I'm aware of a 5-star hotel in Dubai that normally functions at a headcount of about 550. They have reduced that headcount as a function of what's happened to date to 270. What they are saying is actually they function really well, because they do have some people who have been stuck there. They function really well at that headcount, and they don't see that even at full capacity, they need to go back to a 550 level. That just demonstrates that in all businesses, there often, especially during growth, there often is a level of fat. So that definitely you need to get rid of. But beyond that as well, you'll need to get people to do multiple jobs. You need to have to be more efficient. You'll have to discuss, replace salaries with incentives where possible. In many cases, you will have to also let go of people or look at unpaid leave. So cost cutting is a big element. Own capital, obviously that tends to be limited, but that's one of the easiest and quickest capital sources available. Friends and family, again, quicker and less onerous than the ones that will follow on. After that, you have developmental finance or government funds. These will have objectives that are beyond capital appreciation typically. They will have development of the economy, development of specific sectors, job creation. They will have other considerations that if you can demonstrate your your value into those objectives, then they will be could be available to you. Of course, in the context of a government that is racing to, save all businesses, not just SMEs, and a government that has less revenues, those are not easy. Plus, developmental finance and government funds can be more bureaucratic. Venture and growth funds, a lot of funds have been raised in the recent past in the GCC, even government-backed venture funds and growth funds for the SMEs. Growth funds, there's not as many of them in the region, and they have always been limited, so it's more of a challenge for, I would say, non-tech SMEs. But these, again, I would say these are more available to people who are in sectors who are witnessing immediate growth or who can see a clear opportunity to go after today, let's say telemedicine or something of the sort. Banks are, to be honest, banks have been always a very remote possibility for the SMEs and the companies that are in the tech space anyway in this region. Add to that when in the situations where they have landed here, the rates tend to be quite high and almost get to equity costs. So not been a very, I would say, suitable source of funding for SMEs and startups in this region. Also, the borrowing here entails a level of liability that is not necessarily matched by bankruptcy laws that support and limited liability situation, and your freedom, etc., can be at risk. So I will put that aside for the purposes of SMEs and venture because I don't think it's a very realistic source. Unfortunately, a lot of the economic support is going through banks, which means that for SME sector, which is largely unbanked, it's hard to tap into that government support, and you need to access it other ways. Which brings me to the sixth source of capital, which is COVID programs. It is early stage. I will not, and I put question marks because I do not have a sense of the speed or difficulty of accessing those programs. Obviously, where you can delay paying fees to the government, not be charged penalties, those are obvious and you should totally avail them. But more direct programs should be applied to, can be applied to as well. Going into the categories that we sort of buckets that we put ourselves in as businesses, starting with the easy one, which is you're going through the crisis. We talked about making sure that you are aware of whether your growth is temporary or it's going to peak and come down, or so that you don't end up in an oversupply situation, but also ensuring that you have the liquidity so you don't grow to death, let's put it that way. First thing I would say here, health check first. These do not grow at the cost of your employees or customers. This is very serious, and you have to ensure that you have the resources to ensure that you're not putting anyone at risk. I will ask the hosts here to circulate what I prepared a COVID checklist that I've shared with our portfolio and many other companies that you can look at, but this is something important to do amongst other things on that checklist. You should, and everyone should, be cutting costs. We've already discussed that. Try to access whatever you can of the COVID program. Implement a very, very strong cash discipline. Probably stop marketing. If growth is being directed to you anyway because of the market situation, then you should be taking those funds and applying them to the added labor that you need, to the added working capital that you need to fund, whatever that may be. For additional funding, your best route is probably existing investors. You can expand that. I would recommend doing that through relationships from existing investors. Those are the best references you will get. Communicate with your stakeholders. When you are raising new money, be very flexible. One of the very I would say, one of the most active government-backed funds in the region. The gentleman who heads that, made an interesting comment saying that he's seeing a lot of humility from businesses that were previously sort of taking the take it or leave it attitude. To be honest, I don't recommend a lack of humility under any scenario, but certainly, you have to be flexible today. Focus on getting the cash in. Don't be penny wise, pound foolish. Be flexible on valuation, on investment terms. Surviving this will be a huge win, and that's what should be your focus. In this context, whatever governance measures you have in place will help you. As an investor, if I see a company and they need money, particularly if they need it fast, particularly if they need it in a hurry, and they don't have the reporting in place, their analytics are not clear, they don't have any form of advisory forum, whether it's a board or similar, I find that they're not very transparent. I'm very unlikely to, even consider them. So having these measures in place is very, very important. Also, be transparent with stakeholders about what your experience is. Even in a growing sector, you're catering to X level of demand. Be realistic and say that, look, I'm in e-grocery or I'm in a food delivery. This is unusual. I will go back down to X level. So let's, look at the business model accordingly. Be connected to your local community. See what others are doing. Communicate with regulators, and preferably communicate with regulators, together with other members of your industry. If you have a robust business model that is challenged temporarily, you have to manage your fixed cost base. Do it as humanely as possible. Do it as intelligently as possible. I don't know if some of you might have heard the Visa CEO came out and said that he is not going to be firing anybody. What they experienced during the last crisis, which was a global financial crisis, was that they were going to make a profit in any case, but lower than they had anticipated. So I don't remember the numbers, but so I think these are right. But so they let go of a lot of people. Instead of making 20 billion of profit, they made 19.6 billion. What he said is that he felt that their recovery after global financial crisis and their ability to hire people was extremely damaged, and that helped their competitors. So, remember that when you will be hiring again, people will remember how you handled this crisis. Of course, when it comes to SMEs, it's a bit different, and it's totally understandable that you are going to have to let people go. You are going to have to cut costs, but wherever possible, do things. Especially, I think that the more lower paid employees you have in your firm, the worse the situation they'll be in. Living expenses when they can't travel back home. Food allowances, etc. You need to think about all these things. Investors will believe you when you show them the right data. If your business model has a robust long-term demand perspective, but they want to see that you can handle a crisis, that you show cost discipline, that you show agility. Use China examples. I was talking to somebody who was it's in a particular sector, and they were showing me that their equivalent sector had bounced back in China very quickly once the full ban was lifted. So use parallels where you can find them, but also demonstrate discipline in terms of how you manage cash. Other thing to look at is that you could be in a good growing sector, a competitor may be in a similar position, maybe consider merging. That will allow you to reduce costs, allow you to tackle the market when it recovers with a more efficient stock base, a bigger market share. If not mergers, partnerships, at least associations that allow you to have dialogue with the regulator, with the policymakers, with your landlords, with your all retailers. So I think a lot of cooperation and working together will work. The main thing I think here is that you need to communicate your challenges to the stakeholders and be very, very realistic about the recovery business plan. If you remember on this particular bucket, we discussed that the recovery timeline may vary from one thing to another. Once things open up, you might go to a shop and start buying some non-essentials, you keep your distance, etc. But are you going to sit in a closed cinema? Are you going to start using the Ubers and Careens immediately? Maybe that will take a little bit longer for people to get comfortable with. So, just be realistic and see how that affects, how different timelines affect your cash needs when planning for fundraising. Finally, if you are in the bucket where either the industry or the business model is severely challenged, you need to go back to the drawing board. Questions you need to ask yourself is, can you pivot? Do the resources and the, whether the people or the IP or the assets, whatever or context, user base, whatever it is that you have, customers, are these things that can be leveraged to do something else that is needed either now or will be needed. Alternatively, look at your resources and see if you can provide them to somebody who needs them. If you have employees who work at a chain of restaurants, all of which are closed down, and you don't have much of a delivery business, can those people be redeployed to work for one of the booming e-commerce businesses? And can you find a way to temporarily reduce your costs, share costs, or at least, reallocate the resources in the economy? Try to wind down a lot of your costs while you do all of this, because obviously that if you're coming to this conclusion, it means that the income is not coming in, so you need to wind down your costs quite a bit. Closing out liabilities. Now I've talked about, I say here on the slide that cover yourself legally. The reason I say that is that if you have you need to understand the risks associated with running a cost base when the income is not coming in. You will be incurring ongoing liabilities, and you need to know that what are the legal ramifications of that. You are responsible towards people to cover their end-of-service benefits, getting them back home, their expat workers. So you need to look at your capital and make sure that your obligations are attended to. It's not all lost, because obviously if you can find a pivot, if you can find an alternative use for resources, this will be a good outcome. Even if you have to wind down a lot and rebuild again, your ability to demonstrate responsible behavior, your ability to prioritize capital use will be something that the future stakeholders would look at. Now, what I haven't covered here, and it's not a basket that I've mentioned here, is ideas. Of course, we're sitting in this very unique situation, and there are a lot of entrepreneurs on the call who I suspect are coming up with a lot of ideas and new business models to come into. You can start discussions, you can build your cases, be realistic on when you will start, obviously, but there's no harm in starting conversations, starting the thinking process. And from what I can tell, people are listening. They may not put pen to paper or write a check today, but people do have the time. Somehow they're sitting at home. There's less time spent commuting and traveling and running to meetings and events. So use that and leverage that, and it might actually pay off. Just to summarize, it is a buyer's market. Survival is key. Be flexible. Structuring is an option. You can trade upside for downside protection. Investors are very amenable to downside protected structures. Be realistic on timelines. Don't think that, I had a business that I'm on a board of a business. The first time we asked them in February to come with a plan to address the situation, they had a very happy outlook on life, where, after May, we were all hunky-dory and back to normal capacity utilization. That board minute was 10 minutes long because we all refused to even go through a restructuring plan that was based on such unrealistic analysis. So we sent them back to the drawing board, and, We want to see better understanding of what's happening. We want to see scenarios. We want to see your ability to be flexible through the scenarios, and then at the creativity around that as how to replace the income. Flight to quality. Quality comes from obviously your business model, your governance, your information sharing, your transparency, your communication, your business planning and prospecting, your agility, your cost discipline, your cash flow discipline. And finally, flight to relationships. Here you should be engaging, communicating, and really reaching out to people. I tell you, I have a list of people that I want to reconnect with. Some I'm always in touch with, others I haven't spoken to for a long time, but I think that this is a good time to reconnect. And I'm systematically going through that list, calling a few people every day, and it's been great. I think that basically covers sort of my views on this, and what I have on this last page is just a sample or an extract of some of the resources that are coming out of the COVID programs that can be available. Please do try to access these, and I really recommend working with people from your own industry, from your own communities, to get clarity around how to avail them. Give feedback where possible to the regulators on what you can't avail and why, and it is a live situation. Governments are trying their best, and you should be, and it's not limited to governments. Obviously, people like landlords can also be one of the targets there. Just before I got in this call, I saw that Majid Al Sultan is waiving rent for the period that the malls are mandatorily closed. So, do engage, do communicate, and do look into these programs. So that's it from the presentation. I'm going to turn it over to questions. I'm just going to go through them systematically. And please bear with me because not all of them are maybe relevant. Some people, okay, so we have seen governments in other countries roll out plans to support small businesses by paying part of their salary for 3 months. Can we expect this here? Small businesses are a key part of the economy, and most of them will close within a few months. Yes, Jane, you're right. It is a very important part of the economy, and it accounts for a significant number of jobs and, importantly, job creation, which is very important in our economy. Saudi has announced payment of salaries for Saudi nationals, 60% of the salary. And there will be, I expect, Qatar has also announced, I think, 100%. I have not seen others, but they may come in. Obviously, the challenge is in the UAE in particular that the expat workforce is quite large, and that has not to date been addressed. But there will be other ways in which governments will support businesses, cutting on visa costs, license renewal fees, etc., that should create the liquidity to support them in direct ways. But I hope to see something along those lines as well. With so much uncertainty in the market, it is the question from Manya Paman. With so much uncertainty in the market, it is very difficult to project cash flows. From your experience, how do you expect the valuations will be made? And moreover, how realistic will they be? Look, I think before valuations, your first question is on cash flows and then valuations. So cash flows first. I think cash flows, you're right, are very difficult to project. What I ask businesses to do is scenarios. So let's say you are operating in a mall, or you're operating a gym. You've gone down in Dubai. You've gone down to zero revenue. Maybe you've managed to do some level of online stuff that's getting you some income, but it's small in comparison. But you have this cost base. So the way you do your cash flows is you look at recovery in different scenarios: slow recovery, starting, say, after Ramadan, and then maybe you have the summer months, and then maybe virus picks up again, you have a slowdown again, and so you go in ups and downs. Other scenarios you can assume are a few months, a longer period of zero revenues, and then picking up very slowly. What I would not, so you can do different percentages on recovery by month. What I would not do is say that you're going to go back to, say, your December 2019 levels by in 6 months' time. I think that is an unlikely scenario. You can model for it, but keep the model should be a monthly model running into, at least the middle of next year with different percentages of, let's say, ramp up. Valuations will of course take the downturn and your cash needs into account. There'll be a few impacts on valuation. The first impact will be that of comps. Obviously, the public markets, the equity markets have come down, so that will affect your valuation. It will be benchmarked to your sector comparable there. Your own cash flows are showing shrinkage instead of growth. That usually is bad. But I would say that everybody will take into account that this is a COVID-driven downturn, and you can put yourself in a position of sharing the pain by doing some of the structuring where, okay, if we recover earlier than we thought, then can get us back to a little bit of a higher valuation, and in exchange for that will protect you and give you, X% return. How realistic valuations will be, unfortunately, I don't know how to answer that question. It will depend a lot on how much we contain this virus. Ultimately, the virus might mutate and take a weaker form, which sometimes viruses do because that ensures their propagation. Vaccine will take longer, more than years by what I'm watching, or, cures that are reliable. But how realistic they will be is a very difficult question. Rami Tahir, how long do you see the overall recovery happening? 2 to 3 years to normalize? Yeah, I think to normalize, probably, it won't go back, but it will vary a lot by sector. It will vary a lot by country. So I wouldn't say 2 to 3 year normalized blanket. Some things will come back quickly and back to levels as soon as things open up. Others will take longer to normalize. Can you tell us more about pivot strategies? So pivot strategies is, let's say you have, actually I'm going to give you an example because that's easier. So I'll give you actually an example of something I know. A catering business that caters to schools and nurseries, working in the rented kitchen of a hotel, actually. So the hotel kitchen is not used at the time when this business requires a kitchen, and they use it and pay rent, and it's a whole set of kitchen, so it works well. Obviously, schools and nurseries are shut down. The hotel now needs to cut costs, but they do have a certain number of people stuck in the hotel that need room service and food. So what they do, what they have done actually, the restaurant business, is the resources that this business has, because that is all the business of the company, they direct it towards serving the hotel guests, and hotels is able to cut its costs on the kitchen and kitchen staff side. So that's a pivot of, based on resources. I hope that answers your question. Another question of how long the recovery will take. I wish I knew, but like I said, it'll depend a lot on the sectors and the different countries as well. Question from Kavit Palija. The challenge of funding could be addressed by opening the market to international banks and liquidity pools. However, the limitations in the legal system does not give institutions comfort on enforcement of security. Lack of corporate governance reporting adds to complexity. Do you have any insight on how the GCC policymakers are planning to address these challenges? Look, I think that things like foreign ownership, setting up licenses as foreigners, corporate governance, these are things that the GCC governments have been working on for some time. I would not say that that's the priority today. Today, policy is focused on the health issue and the economic recovery issue. The other thing I would say is that the foreign institution, today people are, going for, like we said, flight to quality, flight to relationship. So international institutions that haven't been to the region, bringing money in today is, in my view, an unlikely scenario. And also what happens typically in these environments is that their money does go to things like, the United States and dollars. So I think these are very important things. They need to be addressed, and I think the governments are working on it. We should all be working on things like corporate governance. But I don't see that as a quick solution to the funding problem today. Question, are you aware of COVID programs in Oman? I am not specifically aware of programs, but usually the lawyers tend to cover, I know if you go to the Denton's website, they do have a list of GCC, actually if I have it open, I don't. I will have the organizers send that link, but it's a list of countries with their COVID support measures that hopefully has Oman on it. I do not know for sure. In terms of banks, are there any programs aimed at startups as opposed to SMEs that have their own assets to back up loans? So SMEs don't necessarily have own assets, and I will go back to what I said in the presentation. My view of the banking sector here is that it does not very well cater to the SME or startup space. That's for a few reasons. One is, as you mentioned, they are often looking for assets and collateral. When they're not looking for that, they're looking for things like personal guarantees, which is tough. And when they do lend, I have seen SME lending from local banks at, higher than equity IRRs that some private equity funds make on their deals. So I don't think that is a viable bucket in the way it has developed today for SMEs. I further think that all business owners, whether SMEs or not, but people who are not sort of flush with capital, think about the lending space here because of the limited liability laws here, because of the debt imprisonment issues that still exist in our legal system. I would just caution everyone on that one. For most businesses who are, this is from Fahim Al Musa, for most businesses who are doing millions using their human capital, do you think it is fair, human and logical to start terminating employees at the first curve? Yes, this is a moral question. I think if you have cash reserves and if you are owned by a business family or one individual, it is probably, in my view, and this is very personal to me, that you should try to keep your employees and keep their livelihoods and not abandon them at the first instance. I mentioned the visa incident. The CEO admitted that they suffered having fired people in the last crisis and were not willing to repeat that mistake. But I think there's two things that you have to think of. First is that not every business will have the luxury to do that. Businesses also today tend to be leveraged, so they don't necessarily have the capital to do that. Their owners, if they're singly owned, can potentially do it. It's a personal choice. But for publicly owned or publicly listed businesses, which are owned by multiple shareholders, it is very difficult for a board or management to make that call because it's not your money. I'll give you an example. It could be a business that is owned by institutions, including pension funds. And the pension fund is, again, money going to and money of citizens and pensioners, and so should they be paying for this? So I think it's a very complicated question. My personal view is that if you can, and you're an owner, and you have the wherewithal, and the decision making it impacts you and people who you can talk to and who can afford it, then I would obviously think that we would try your best to support your employees through this period. I'm looking at the time, and it's 4:01. So I will end it now. I would once again like to thank everyone for joining and for listening. I hope this was somewhat helpful or at least interesting. And everyone stay safe and good luck with everything. Thank you.